In this lesson, we will discuss the reporting items in the income statement. Note that the income statement is very important to analysts and other users of financial statements, as the income reported is used to predict a company's future earnings. So now let's look at the income statement of DFW Corporation. First off, the income statement summarizes the profit and loss generating activities that occurred during a particular reporting period. So for DFW Corporation, we look at the revenues, cost of goods sold, various expenses that occurred during the reporting period, which is the year ended December 31, 2011. So the income statement covers a period. Now, the income statement often makes a distinction between the operating items and non-operating items. So here again, we see that the operating items begin with sales revenue, cost of goods sold, and operating expenses with a subtotal of 1,175,000, yielding operating income of 683,750. Now, on the non-operating section, we have other income expenses, and under that we have interest revenue and interest expense. Now, these are non-operating because the interest revenue relates to interest from investments, for example. Interest expense relates to an expense incurred as a result of financing. So the other income expense category is the non-operating section. Now again, the operating items yield the operating income, and we can describe the operating items as related to the day-to-day business operations of the company. Now let's recap some examples of operating items in the income statement. We have sales revenue, or some companies would have net sales, cost of sales or cost of goods sold. We may have selling, general and administrative expenses. For DFW Corporation, we also have loss from the write-down of inventory. So the inventory value was reduced. It could be as a result of the inventory becoming obsolete. Now let's note that interest expense is a non-operating item in the income statement. Let's turn our attention to the earnings per share section. Earnings per share, EPS, is the amount of income achieved during a period for each share of common stock outstanding. All corporations whose common stock is publicly traded must disclose EPS. Now, the basic earnings per share is computed as net income less any preferred dividends divided by the weighted average number of common shares outstanding for the period. So for DFW Corporation, the basic EPS is 1.27, which means that we pretty much divided net income less any preferred dividends. Now, preferred dividends are dividends paid to preferred stockholders. Not all companies issue preferred stock, but if they are issued and they are preferred shareholders, any dividends paid out to this special category of shareholders will be deducted because, again, the EPS is earnings per common share. So we want the earnings available to common stockholders. So we need to subtract preferred dividends from the numerator and divide by the common shares outstanding for the period. Now, common shares outstanding implies the shares that are out there trading, not repurchased by the company. Now, the diluted earnings per share includes the effect of dilutive securities. Now, such securities dilute the common shares outstanding. They are not shares at the moment, but if exercised, for example, they would increase the number of common shares outstanding and dilute the earnings per share calculation. Examples are convertible debt securities and employee stock options. Now, diluted earnings per share consequently is always less than or equal to the basic EPS because we would typically probably be using a larger denominator. Now let's focus on the principles that guide the recognition of revenues and expenses in the income statement. And we start off with the revenue recognition principle. Under the revenue recognition principle, revenues must be realized and earned before it can be reported in the income statement. Realized or realizable means that the company's net assets have increased. Remember that net assets is equity. So as a result of the revenue transaction, again, the company's net assets have increased. And it could either be because the company has received an asset, for example, cash or account receivable, or satisfied a liability. That is, the liability has been satisfied and it's reduced. And an example could be unearned revenue. Now let's discuss earned. Earned means that the company has done everything it must do under the terms of sale. For retailers such as Target or Marshalls, revenue is generally earned when title to the merchandise passes to the buyer. For example, when the buyer takes possession of the merchandise. Now, the right of return period should have elapsed, or the returns should be estimated by the company with some certainty, and the returns will be subtracted. That is, the estimated returns will be subtracted to get net sales. For companies operating under long-term contracts, the earning process is typically measured using the percentage of completion method. That is, by the percentage of costs incurred relative to the total expected costs. Revenues for financial or insurance services, for example, are recognized when the services are provided. Interest is earned by the passage of time, which implies that each period, a bank, for example, accrues income on each of its loans and establishes an account receivable on its balance sheet. Let's now look at expense recognition. And the expense recognition principle again is the matching principle. Generally, expense recognition is based on the matching principle. That is, expenses are recognized in the same period as the related revenues. Now, the income statement is prepared based on accrual accounting. Accrual accounting is simply the recognition of revenues and expenses even if cash is not received or paid. Note that accruals are vital to the fair presentation of the financial condition of a company, as they may impact both the recognition of revenue and the matching of expenses.